This video is for educational purposes only and does not constitute investment advice. The information is intended for a global audience, not specific to any country or region. Am I the only one that didn't know what crypto actually is? You've probably heard people talking about crypto everywhere. On the news, on your social media feed, maybe even from that one friend who won't stop bringing it up. So what is it really? Think of cryptocurrency as digital money. It's like the dollars and cents you have in your bank account, but it only exists online. You can't hold a Bitcoin in your hand like you can a $50 note. It's all stored on computers in a massive shared public ledger called a blockchain. This isn't money that's issued or controlled by a government or a bank, which is a massive part of its appeal for some people. The magic word here is decentralized. That's a fancy way of saying no single person, company, or government is in charge. Traditional money, like dollars, euros, or yen, is controlled by central banks. They can print more of it, which can affect its value. With most cryptocurrencies, the rules are set by computer code and agreed upon by everyone using the network. This means it's a bit like a digital democracy for money. The first and most famous crypto is, of course, Bitcoin, which was created back in 2009. But now there are thousands of different cryptocurrencies out there, each with its own purpose and technology. Now let's talk about that blockchain thing I mentioned. Imagine a giant digital notebook that everyone can see but no one can change. Every time someone sends or receives crypto, a new entry or block gets added to this notebook or chain. This block is linked to the one before it, creating a chain of transactions. Because this notebook is shared across thousands of computers worldwide, it's incredibly difficult to cheat the system or change past transactions. This security and transparency is one of the core ideas behind why people trust cryptocurrency, even without a bank being involved in the process, to verify everything for them. So to boil it all down, cryptocurrency is a type of digital cash that uses some very clever technology called cryptography to keep it secure. That's where the crypto part of the name comes from. It's a peer-to-peer system, meaning you can send it directly to someone else without needing a middleman like a bank or PayPal to process the transaction. This can make transactions faster and sometimes cheaper, especially for sending money across borders. It's a whole new way of thinking about finance, ownership, and what money can actually be in our increasingly digital world, which is both exciting and, let's be honest, a little bit daunting. So you've wrapped your head around the basic idea of crypto. Now you're probably wondering, okay, this sounds interesting, but how do I actually buy some? It's a lot easier than you might think, and it's very similar to how you might buy shares in a company. The most common way is through a cryptocurrency exchange. Think of these exchanges as a digital marketplace, like a stock market, but specifically for cryptocurrencies. You sign up for an account, verify your identity just like you would with a bank, and then you can deposit your local currency to start trading. There are heaps of exchanges out there, and some are more beginner-friendly than others. Big international names like Coinbase, Binance, Kraken, or Bitstamp are popular and available in many countries, but there are also local exchanges in different regions that might suit your needs. Most platforms let you deposit money directly from your bank account, or even use a credit or debit card, making the process familiar and straightforward no matter where you live. You simply create an account, go through a quick identity check to comply with international anti-money laundering laws, and then you're ready to link your bank or card and transfer some funds to start your crypto journey. Once your account is funded with your local currency, buying your first bit of crypto is usually just a few clicks away. You'll see a list of available cryptocurrencies like Bitcoin, Ethereum, and many others, along with their current price. You can then choose how much you want to buy. You don't have to buy a whole Bitcoin, which is lucky because one of those costs a small fortune these days. You can buy a tiny fraction of a coin, which is called a Satoshi for Bitcoin. You could start with as little as $20 or $50, euros, or your local currency to just get a feel for how it all works. Another way to get crypto is through a peer-to-peer transaction, although this is a bit more advanced and I wouldn't recommend it for your very first time. This is where you buy directly from another person, using a platform that acts as an escrow service to make sure both sides of the deal are fair. There are also crypto ATMs in some cities, which look like regular cash machines, but let you insert cash and receive crypto sent to your digital wallet. These are less common and often have higher fees. So for most people, a reputable online exchange is absolutely the best and safest place to start your buying journey, no matter where you are in the world.
Perfect.
All right, so you've bought your first bit of crypto, congratulations. But now comes a super important part. Where do you keep it? You wouldn't just leave thousands of dollars in cash sitting on your kitchen table, and the same logic applies to your digital assets. When you buy crypto on an exchange, it's usually held in a wallet that the exchange manages for you. This is called a custodial wallet because they have custody of your funds. It's convenient for sure, but it comes with a saying in the crypto world: not your keys, not your coins. This means if the exchange gets hacked, you could lose everything. For better security, especially if you start accumulating a significant amount, you'll want to move your crypto into a personal wallet that you control. These are called non-custodial wallets. With these, you are given a unique set of words called a seed phrase or recovery phrase, which is usually 12 or 24 words long. This phrase is the master key to your wallet. You must, and I mean must, write this down and keep it somewhere incredibly safe and offline. Never store it on your computer or as a photo on your phone. If you lose this phrase, your crypto is gone forever. If someone else finds it, they can steal all your crypto. There are two main types of personal wallets you should know about. The first is a hot wallet. This is a software wallet that lives on your computer or your smartphone. They are called hot because they are connected to the internet, which makes them convenient for sending, receiving, and trading crypto frequently. Examples include wallets like MetaMask for your web browser or Trust Wallet for your phone. They offer a good balance of security and convenience for smaller amounts, but because they're online, they still carry a small risk of being hacked if your device gets a virus. The most secure option, the absolute gold standard for storing crypto, is a cold wallet, also known as a hardware wallet. This is a small physical device like a USB stick that stores your private keys completely offline. Brands like Ledger and Trezor are the most well-known. To make a transaction, you have to physically plug the device into your computer and press buttons on the device itself to approve it. This makes it virtually impossible for a hacker to steal your crypto remotely. If you're planning to invest a serious amount of money, spending a couple of $100s on a hardware wallet is one of the smartest investments you can make for your peace of mind. Now we get to the big question. Why are so many people putting their hard-earned money into this stuff? What's the appeal? For a lot of investors, the number one reason is the potential for huge returns. You've all heard the stories of people who bought Bitcoin for a few dollars years ago and are now millionaires. While those massive gains are less common now, the crypto market is still known for its volatility, which means prices can swing up dramatically in a short period. People are drawn to the possibility of their investment growing much faster than it would in the traditional stock market or a savings account. Another major reason is the idea of diversification. Financial advisors always say you shouldn't put all your eggs in one basket. By adding cryptocurrency to an investment portfolio that already includes things like shares, bonds, and real estate, you're spreading your risk. The crypto market often moves independently of the stock market. So, on a day when your shares might be down, your crypto assets could be up, helping to balance out your overall portfolio. It's seen as an alternative asset class that can potentially protect against downturns in other areas of the economy, which is a very attractive proposition for savvy investors. Beyond just making money, some people invest in crypto because they believe in the technology and its future potential. They see blockchain and decentralized finance, or DeFi, as a revolutionary technology that could change the world, much like the internet did. They believe it can make financial systems more efficient, transparent, and accessible to everyone on the planet, especially people in developing countries who don't have access to traditional banking. For these investors, buying a cryptocurrency is like buying a share in a groundbreaking tech startup. They are investing in the long-term vision of a more open financial future. Finally, there's the appeal of hedging against inflation. You've seen how prices for everything from petrol to groceries have been going up. When governments print more money, the value of each dollar you hold can decrease over time. This is inflation. Some cryptocurrencies, particularly Bitcoin, have a fixed supply. There will only ever be 21 million Bitcoin created. Because of this scarcity, some people see it as a digital gold, a store of value that can protect their wealth from being eroded by inflation over the long term, much like people have historically used physical gold for the same purpose. Okay, we've talked about the exciting potential for making money, but now we need a serious reality check. I would not be doing my job if I didn't tell you about the massive risks involved. The number one risk is volatility. I mentioned this before as a positive, but the sword cuts both ways. Crypto prices are famous for their wild swings. It is not at all uncommon for a cryptocurrency to drop 20%, 30%, or even more in a single day. You have to be prepared for the fact that the money you invest could lose a significant amount of its value very, very quickly. If you can't stomach that kind of roller coaster ride, crypto might not be for you. The second major risk is the lack of regulation. While governments, including Australia's, are starting to create rules for the crypto space, it's still very much the Wild West compared to the stock market. This means there's less protection for investors. If an exchange you're using goes bankrupt or turns out to be a scam, there's often no government body or insurance scheme, like the financial claims scheme for banks, that will step in to help you get your money back. You are largely on your own, which means you have to be extra careful about who you trust with your funds and your personal information. Then there's the risk of scams and hacks. Because crypto is a new and complex technology, it attracts a lot of scammers looking to prey on beginners who don't know what they're doing. You'll see fake giveaways on social media, receive phishing emails pretending to be from your exchange, or be tricked into investing in a rug pull project where the creators just disappear with everyone's money. On top of that, exchanges and individual wallets can be targeted by sophisticated hackers. Security is a constant battle, and one small mistake on your part could lead to a total loss of your investment with no way to recover it. Finally, there's the technology risk itself. You are investing in a very new and experimental technology. While blockchain has been around for over a decade, it's still evolving. There could be bugs in the code of a specific cryptocurrency project that get exploited. A newer, better technology could come along and make an older coin obsolete. Or governments around the world could decide to crack down with harsh regulations that stifle innovation and cause prices to crash. You are betting on the future, and the future is always uncertain, especially when it comes to technology that is developing at such a rapid pace. So you understand the basics, you know the risks, and you're still keen to get involved. Good on you. The good news is, there's more than one way to invest in crypto, so you can choose a path that matches your comfort level and your goals. The most direct and common method is simply buying and holding the coins themselves. This is what we've mostly been talking about. You pick a project you believe in, like Bitcoin or Ethereum, you buy some on an exchange, move it to a secure wallet, and then you hold on to it for the long term, hoping its value will increase over time. This is often called hodling in the crypto community. If buying coins directly feels a bit too hands-on, you could look into crypto-related stocks or ETFs. An ETF is an exchange-traded fund, which is a basket of assets you can buy and sell on the regular stock market. In recent times, Bitcoin and Ethereum ETFs have been approved in places like the United States and are available in Australia too. This means you can get exposure to the price movements of crypto without actually having to buy and store the digital coins yourself. You just buy the ETF through your normal stockbroker. This is a much simpler, more regulated way to invest, which is perfect for many beginners. Another approach, which is a bit more active, is using crypto interest earning platforms or decentralized finance or DeFi apps. These platforms allow you to lend out your cryptocurrency and earn interest on it, a bit like a high-yield savings account but for crypto. The interest rates can often be much higher than what you'd get from a traditional bank. This strategy, sometimes called staking or yield farming, lets your crypto assets work for you and generate passive income. However, it comes with its own set of risks, as you are trusting your funds to a third-party platform or a complex smart contract that could have vulnerabilities. For those with a bit more capital and a higher risk tolerance, there are crypto venture capital funds or managed funds. These are professionally managed funds that invest in a portfolio of different cryptocurrencies and blockchain-related startups. This is similar to investing in a traditional mutual fund, where you give your money to experts who make the investment decisions for you. It provides diversification across many different crypto assets, but these funds usually require a large minimum investment and charge management fees. So it's generally an option for more serious high net worth investors rather than someone just starting out with a few $100s. One of the most confusing things for newcomers is trying to understand why crypto prices move so much. It can seem completely random, but there are some key factors that drive the volatility. The biggest one is simple supply and demand. Just like anything else, if If more people want to buy a cryptocurrency than sell it, the price goes up. If more people are selling than buying, the price goes down. Because the crypto market is still relatively small compared to the stock market, even a few large buy or sell orders from a whale, an investor with a huge amount of crypto can cause the price to swing dramatically. Another huge influence is news and market sentiment. The crypto market is incredibly sensitive to hype and fear. Positive news, like a major company such as Tesla or MasterCard saying they will accept Bitcoin as payment, can send prices soaring. On the other hand, negative news, like a government announcing a ban on crypto mining or a major exchange getting hacked, can cause a massive crash. Social media, especially platforms like X, formerly Twitter, and Reddit, plays a massive role in this. A single tweet from an influential figure like Elon Musk can literally add or wipe billions of dollars off the market in minutes. Then there's the influence of regulations. Governments and financial regulators around the world are still figuring out how to deal with crypto. Every time there's a new announcement about potential rules, the market reacts. News of favorable regulations like the approval of a Bitcoin ETF, which makes it easier for big institutions to invest, is usually very bullish for prices. Conversely, talk of stricter rules, higher taxes on crypto gains, or outright bans in major economies like China or India can create a lot of fear and uncertainty, leading to widespread selling and a drop in prices across the board. Finally, we have the technology and adoption cycle. The price of a specific cryptocurrency is also tied to its underlying technology and how many people are actually using it. If a project like Ethereum releases a major upgrade that makes its network faster and cheaper to use, that can increase demand and push its price up. Similarly, if a new blockchain game or a DeFi application built on a certain network becomes incredibly popular, it drives up the value of that network's native coin. Real-world adoption is key. Ultimately, for a cryptocurrency to have long-term value, it needs to be more than just a speculative asset. It needs to have a genuine use case. All right, if you've made it this far, you're probably serious about getting started. So let me give you my best no-nonsense tips for beginners. My number one rule, and please listen to this carefully, is to only invest what you are willing to lose. I mean it. Do not invest your emergency fund, your house deposit, or money you need to pay your rent next month. Because of the volatility we've talked about, there is a very real chance your investment could go down significantly. Start small, with an amount of money that wouldn't financially ruin you if it disappeared tomorrow. This will also help you learn without the stress. Second, do your own research. This is so important. Don't just buy a coin because your mate told you it's going to the moon or because you saw some random person on TikTok hyping it up. Take the time to understand what you're investing in. Read the project's white paper, which is a document that explains what the project aims to do. Look at who the team is behind it. Check out its community on platforms like Reddit or Discord. Is it an active, healthy community, or is it just full of hype and spam? Making informed decisions is the best way to avoid scams and invest in projects with real potential. My third tip is to think long-term. Don't get caught up in trying to time the market or make quick profits from day trading. That's extremely difficult even for professionals, and for a beginner, it's a recipe for disaster. A much better strategy is to use dollar cost averaging, or DCA. This means you invest a fixed amount of money at regular intervals, say $50 every fortnight regardless of the price. This approach smooths out the volatility over time. When the price is high, you buy less, and when the price is low, you buy more. It's a disciplined, less emotional way to build up your position over the long haul. Finally, start with the big, established players. Don't dive straight into obscure new altcoins with silly names promising 1,000 times gains. Stick to the most well-known and reputable cryptocurrencies for your first investments. That means starting with Bitcoin, BTC, and Ethereum, ETH. These have the longest track records, the largest market capitalizations, and the most security and developer activity. They are considered the blue chips of the crypto world. Once you get more comfortable and have a better understanding of the market, you can then start exploring some of the smaller, higher-risk projects if you choose to. Let's wrap this up with the most important topic of all, staying safe. The crypto world is full of opportunities, but it's also crawling with scammers trying to get their hands on your money. Your first line of defense is to be incredibly skeptical. If an offer sounds too good to be true, it absolutely is. Nobody is giving away free Bitcoin on YouTube or X. That celebrity giveaway is a scam. That person who direct messaged you with a secret investment strategy is not your friend. They are trying to steal from you. Never, ever send your crypto to someone else's wallet with the promise that they will send you back double. It will be gone forever. Next, you need to practice excellent digital security, or what we call cyber hygiene. Use a strong, unique password for every single crypto exchange or service you sign up for. Don't reuse the same password you use for your email or social media. Even better, use a password manager to generate and store complex passwords for you. And most importantly, enable two-factor authentication, or 2FA, on every account. Use an app like Google Authenticator or Authy instead of SMS-based 2FA, as SIM cards can be swapped by criminals. This adds a crucial extra layer of security to your accounts. Be extremely wary of phishing attempts. Scammers are very good at creating fake emails and websites that look exactly like the real ones for popular exchanges like Binance or Coinbase. They'll send you an email with an urgent warning, like your account has been compromised. Click here to secure it. The link will take you to a fake login page where they will steal your password. Always double-check the website URL before you enter any login details. A better habit is to never click on links in emails. Instead, always navigate to the exchange's website by typing the address directly into your browser. And my final piece of advice, which I mentioned earlier but it's worth repeating, is to secure your seed phrase. If you use a non-custodial wallet, that 12 or 24-word recovery phrase is the key to your entire crypto fortune. Write it down on paper, or even better, stamp it into metal. Store it in multiple secure offline locations. Never, ever, under any circumstances, type it into a computer or a website. Never take a photo of it. Never save it in a text file or in your cloud storage. No legitimate support person from a wallet company will ever ask you for your seed phrase. It is for your eyes only. Your security is your responsibility.